Well, hello to all my fellow big trenders. Price Headley here. It's Monday, August 24th, 2009. Checking in with you this week for another weekly video market outlook. As you may recall, last Tuesday morning I put up an update on this where we said this pullback from Monday was going to be a buying opportunity, and as you see last week, it certainly was after Monday's dip, which I was saying based on the percent R test back just under the key 80 threshold using the Big Trends way, percent R with the 30 bar settings, which again are available on our bigtrends.com site through our tools and resources Trixie chart feature. That was also backed up actually by the pullback in the efficiency ratio, also under its key threshold level of plus 30. And so those set up this low risk retest coming in last Monday's close. Low of $91.40 was a big number. We said it should hold on a closing basis if the market was going to rally, and indeed we got it right under the 92 level the next couple of sessions, and then boom, last Thursday and Friday and into today we got a little bit of a rally. Here it is an hour before the close on Monday, and now we're seeing a reversal pattern. Why? Because if you look at this chart, you're seeing we've run right back into the upper acceleration band, which is about 95.6, and you can see that we've hit this top of the band, we flipped back down, and actually setting up, unless things dramatically improve in the final hour of trading, for a reversal candle where we're getting a attempted rally. It looks like it's going to close in the lower half of the candle, and looks like we're going to see kind of a what we call a doji pattern, as candle followers know, very similar to what we saw, say, back right off of the band back here, due for a little bit of a rest, due for a little bit of a possible reversal. Not saying to get overly bearish here just yet, just saying, look, be locking down your bullish profits for the call last Monday, Tuesday morning, and basically saying, don't be surprised if you see a little bit of a rest. As we look at our other key gauges, it's helpful to look at not just before we look at the other market averages. Let's look at the VIX, the CBOE Volatility Index, VIX. And you can see here that VIX, we had said, coming off of that spike in fear last Monday, VIX popped up just over 28. I'd been predicting that from the prior week before that, and indeed we got that fear spike. Now look what's happened. We've seen VIX dipping back down, hit under 24 last Friday, and so now we're sitting around 25 on the VIX. That's still a relatively low level of fear, and actually we're seeing higher lows in the percent R, which tells me we're getting kind of a possible ready for a possible run back to the upside. Also, efficiency ratio spiked up to its overbought level, did not follow through. Now we're right back to the zero midpoint. Frankly, that makes today's low in the VIX a key number to watch. So we want to see if we're breaking down below today's low. Otherwise, we could be setting up for another ratchet up in volatility, back up towards that 28. Now 29 being the target as the upper acceleration band is starting to edge on up. So you see a little change in trend happening here with a turn up in the 20-day moving average, turn up in the bands. That hasn't been seen obviously for several months, coming off of the March bottom. So that's significant and tells us we might be getting ready to endure a bit of a change in trend. Same thing for the SPY, like the Dow. Here's the SPY, S&P 500 Trust. Nice run right to the upper acceleration bands. Should it surprise you that you're seeing a stall right at the upper acceleration band? No, because compared to when you're breaking outside of the band, now it becomes support underneath a rally. Now here we are coming in from underneath, now running into that resistance band. So I always tell my big trends traders, you don't need to draw in manual support and resistance lines. In fact, you can see that the support and resistance lines have been rising here, but now we've run into the resistance at the upper 20-day acceleration band. You can see even during the rally coming off the March lows, we ran into a first stopping point late March, another one up here mid-April, another one up here ran into it just above it, and then settled back down in as you went to May. Then early June ran up right near the upper band, stalled out. Comparatively, the bottom band typically will act as support unless it truly surges on through there outside of those bands for two straight closes. Otherwise, you're going to be looking at, in this case, resistance up near the upper band. Percent R still bullish, but again, looking for a possible retest again back under the 80 threshold for your next low risk entry. And one more chart looking at the NASDAQ 100. It's interesting because NASDAQ has actually been underperforming compared to S&P and Dow. That's because NASDAQ is underweight in financial stocks, overweight in technology. Financial stocks are what's been leading in the last little rally up over the last week. Comparatively, the Qs are running right back into major overhead resistance right around the 40 level. You can see Friday we closed just in that 40 and a quarter-ish area. Here we are again, showing that same kind of reversal pattern potentially for a possible flip back down. Looks to me like it's time to start booking some bullish profits, time to tighten your stops, and basically not get overly negative right now, but just expect that the market may be due for a breather. So we want to be patient. Let's look for the next low risk entry. In the meantime, be prepared to lock in. Hopefully some of you got some good bullish profits off that last bull retest that we pointed out early last week. So wish you great trading in the week ahead, and if you have any questions, give us a call at 800 Big Trends. Have a great trading week. Trade well.